Very good morning, friends. At the outset, let me welcome each and every one of you for this special session for IBBI evaluation examination, exclusively focusing on the Indian accounting standards topic. Even though the syllabus out of 100 marks may be minimum 5 marks, maximum 8 marks. The spread of this content, it across the syllabus. Not only that, the concepts in the Indian accounting standards with respect to measurement part is very significant for you to appreciate the various concepts in valuation. Today, even though the time available to us will be limited, I'll try to maximize the coverage with respect to the significant areas in this particular topic. Today, I will take you to Indian Accounting Standard 103, which is a very interesting standard. And not only the standard, but the concepts in that standard. Please understand that your questions in examination with respect to case studies may be arithmetic, which is 20 marks. But now in the new syllabus, they have enhanced the case study marks to 26. But the 80% of your syllabus, maybe hardly another 5 marks will be for arithmetic or maybe for formulas. But the 75% of your syllabus is purely concept questions. So there is no fun in actually doing multiple choice questions, maximum numbers. That is not the objective. The objective is to actually get a control over the subject, especially the concept clarity. That only can give you the confidence, whatever may be the questions that is asked in the examination. So be like Dhoni, be prepared for any kind of scenario. Dhoni is a cool man, and in any circumstances, you can see him perform. So surprises will be there from Dhoni. Similarly, the ball will be, the question ball will be very, very unique. So be prepared and don't expect the same question or the model or the same ABCD order. No. Maybe the same question will be repeated also if you are trying for the second time or third time. But remember, the order will not be the same. So always be prepared for the new kind of question every time, but from the syllabus only. So that is why be prepared in the syllabus. So let me now take you to Indian Accounting Standard 103. This is a very interesting standard. Let me start with you the topic here. This is your standard 103. Now I want to make one observation here. Please look at this. This is actually 63 paragraphs only. 103 has only 63 paras. And if you look at the definitions, the definition is in Appendix A. So it's only 63. That's it. And look at the definition, which is in Appendix A. It goes for 2 pages. And look at Appendix B, which is the application guidance, which has 67 paras. Only 63 paras are the standard, 14 are definition, 67 Appendix B. So I will suggest that you go through these 67 paragraphs. Of course, Out of 67, first 4 paras are not there because it has been carved out compared with your IFRS 3. So it is hardly 140 paras. And Appendix B is most important in this entire standard. So read the standard once. That is the catch. Take a printout of it. And if at all you have been having an idea of reading only from the screen, my suggestion, please don't do that. Have a notebook, have a printout, or have a book, Indian Accounting Standard book, and have a pencil, your pad, pen, take notes. That only will give you the comfort in the subject. Okay, good. Now let me take you to this question. Now, India is 103 business combinations. Okay, let me first take you to the first question in this. If you look at the para number 18 here, okay, which is a very important paragraph. Okay, now before going to 18, I'll only take you to para 5. Look at this. This entire standard will discuss only these 4 items. Okay, whenever you are going to acquire a business, okay, acquire a business, actually maybe in our student days, we would have heard about amalgamation, absorption, okay, so many terms we would have heard, and very in a difficult way, the teacher will be giving an explanation between amalgamation and absorption. Actually, nowhere the term and all has been defined anywhere. It's only by usage. So ultimately, it is not the accounting definition that matters. It is the business that matters. See, today business, they define how they have to do it. So people, if they feel the company, I am a private limited company, but there is a public list, there is a public limited company which is listed. Okay, public limited company which is listed. Now, as a private limited company, can I take over a public limited company? Yes, possible. Okay, so it is like so the concept is called reverse merger. Okay, so the business only defines all this. So it is not that the accounting textbook will define. So when you are comfortable with the business, everything is clear actually. So here, these are the only 4 steps, and let me appreciate these 4 steps one by one. So let me take you to this first question. In India is 103, the acquirer shall measure the assets acquired and the liabilities assumed at what date? Okay. Now, don't give me the answers and all in the system. I will take you to the definition part. And in the definition, please look at it. It speaks about various terms here. Acquiree, okay, acquirer, the entity that obtains control. This entire standard will speak about only one term called control. Okay, and of course, when you go to India's 110, that is consolidated financial statement, this concept of control has been discussed in greater detail. Okay, good. So acquiree, the business or businesses, this is very important. Sometimes I'll be only interested to acquire the asset, not the business. Business includes workforce. Business includes licenses. Business includes your process. Okay, so that is why the terminology of business have been defined here, and it has been updated also recently. Please look at this. They updated on 24th July 2020 with respect to the definition business during the pandemic time. And the virus is actually across the world, and it is taking control of the entire world. So we have got a updation for Indian accounting standard for the term business. Maybe coolly the government has actually thought it fit to bring out the definition here. Okay. Now please look at this. So Your para number 18, let me take you to para 18 here. Yes. Look at this. The acquirer, the buyer, shall measure the identifiable assets and liabilities. This is most important. Okay. So whenever you are taking over a business, you are not only taking over the assets, but also the related liability. Okay. And you have to measure the assets and liabilities in current price. That is the fair value. And at what date? The acquisition date. So please look at this. So it is not measurement date, it is not merger date, it is not takeover date. But C and D will look very close to the answer. I repeat, C and D will look very, very close to the answer, but it is not the answer. It is only acquisition date. So 2B for your kind information. Okay, good. Now let me take you to the first question. India is 103. The business combinations does not apply to. Now, why the standard is not applicable? Let me take you to the objective as well as the scope. Remember, guys, every examination question, you have questions from the scope. Okay, and try to actually appreciate this particular paragraph in practical sense, so that you will not miss that particular question. There are many people who have actually missed their examination, that particular mark 60 by just a few marks, and many have cleared by being on 60, 61, 61.5, 62. So it's all because of this marginal questions. It is not necessary that you attempt all for 100 marks. If you are confident about maybe 55 questions or 65 questions or 70 questions, sufficient. You are pass. You need not attempt the remainder 20 questions or 25 questions for your information. Okay. So this India applies to a transaction or other event that meets the definition of business combination. Now I want to make one observation here, that the term business is also defined. The term business combination is also defined. So that is why Appendix A is very important. Read Appendix A. Okay. This India does not apply to the accounting for formation of a joint arrangement. Joint arrangement, there is no combo there. So they will only have a joint control, because this word joint arrangement will have a terminology called joint control. Okay. For example, you have this bank locker. Bank locker ka chabi aapke paas hai. Okay. But can you go and open that bank locker chabi? No. Because there will be one more chabi which will be with the banker. So only when that chabi is also put, then only you can open. So that is why business combination has a very interesting term. Joint arrangement is different. You have a separate standard for it. 111. Please look at this. This is 111, joint arrangement. So 111 will speak about joint arrangement. So it doesn't speak about this. So therefore, even though jointly you do business, okay, but 103 not applicable, you have to go to 111. Now the acquisition of an asset or a group of assets does not constitute a business, because you are not taking over the customers, suppliers, workforce, process, licenses. You don't carry on the business. The going concern is not carried out. Okay, so the focus is only on asset and group of assets. So therefore, this standard is not applicable. Then what is the relevant standard applicable? You have India is 16, property, plant and equipment. You have India is 38. It will be intangible asset, because in case that assets are property, plant and equipment, that is tangible and intangible assets. So therefore, accounting for farmer joint arrangement not applicable. Acquisition of an asset not applicable. Now come to one more thing. Okay, look at 2A. This 2A and 2B are carved in. Please understand why it is carved in. 2A inserted, and in the Appendix B, B1 to B para has been removed. It is called carve out. Okay, in Vinayaka Chaturthi, that is Ganapati Chaturthi time, You will have the Ganpati Murti will be there. How Ganpati Murti will be made? It is made of clay. And to beautify, to get the divinity in that clay, certain unwanted clay will be removed. That is called carve out. And to give more divinity to the clay, okay, then only Murti will be divine. We give eyes to Ganpati, okay, and we also give the eyes to Munjur also. So that is called carve in, okay. So 2A and 2B is carve in, okay. So the requirements of the standard does not apply to the acquisition of an investment entity. See, I told you, no, after 103, you have to go to 110 only. See, it is like you want to go to Calcutta from Chennai. There are direct flights. You have majority of the flights are not direct flights. So one flight will go and it will get down at Visakhapatnam. Then again another it will take. It will again get down at Bhubaneswar. Again it will take off. Then it will only go to Calcutta. Sometimes return also will be like that only. So you will be actually. So direct flights are not. Many are there to Calcutta. So the requirements of the standard do not apply to the acquisition. So once 103 is over, next you have to go to 110, that next stop flight. Okay. So investment entity, please understand, in investment entity, the money I have invested in another company, so they become a subsidiary. But there is no business in it. Because that money is used to invest in another company. And the returns are not active returns. So पसीना करके आप नहीं पैसा नहीं कमाते. Okay, so you only earn money by the passive means, not active means. So therefore investment entity of an investment in a subsidiary that is required to be measured at fair value through PL, that also not applicable. So all the three. So that is why 1D. Okay, good. Ind AS 103, exceptions to the measurement principle. Okay, now this is a very important concept. So let me now take you to that concept first of all. This is measurement principle. So fair value. But you have to measure the assets and liability at fair value. But there are certain assets you will not measure at fair value at all. Why? Why? So I'm now taking you to, this is called exceptions to recognition principle. There is another thing called exceptions to recognition and measurement principle. Another thing is there exceptions to the measurement principle. So I will not measure this. Oh my God. You will not measure this at fair value. Why? Logic is there. Okay. For example, okay, assets held for sale. You had a plant and machinery. You used it for 4 years. You retired that from active use. That means you want to sell it immediately. Maybe you are in the process of finding a buyer. So then, Ind AS 16 is not applicable, property, plant and equipment. So you have to only measure and recognize that asset as per the prescription of Ind AS 105. And already you have done it. So again, doing it is not required for the purpose of business combo. That is why exception to measurement principle. So assets held for sale, take the book value as such, because that is only recently been measured. Then share-based payment transaction. Oh, see, you are going to take over one company. Okay, you are going to take one company. So 70% you are going to buy the shares. 30% will be held by somebody else or a group. Now that particular company's employees already has been assured for share-based payments, meaning they will be given ESOP. Okay, let us assume that employee stock option plan or employee stock option scheme, okay, other is called sweat equity shares, have been granted. And 3 years later only, if they are honest, integrity, loyal to the company, okay, most important, they should stick on with the company, be loyal, okay. then the assured grant of share-based payment at the agreed price will be allotted to them. Wow. So now, in between, there is a takeover. Will that promise be broken? No, you can't. So it has already been measured. So that I will not touch it. So I will not re-measure that, but no, you will not be allotted that. You will be allotted more. You will be allotted less. You will not be allotted. Nothing you can do. Okay. Because there was a relationship and there was a promise already made. So therefore, these things, you will not remeasure it. So when you actually take over a business, you need to understand. That is why in marriage also, in Indian families, marriage is not between two individuals. Marriage is between two families. Okay. Please understand. So, and the persons, two people who are actually marrying, it is not their interest alone matters a lot. It is also their family's interest also matters a lot. So that is why in the marriage setup, there will be a lot of ifs, buts, compromises will be there. Then only it will be a family, nice family. Okay. So then reacquired rights. The acquirer's building was actually given on lease, okay, to the acquiree, maybe 3 years back. So the remainder 7 years lease rights are there. ROU asset, right of use on the asset is still there. Now I'm taking over that company. I'm acquiring that acquiree. That means already 7 years right on use of the asset is still there. Should I have to measure that at fair value? No. It's my own asset here. So therefore, reacquired rights. The acquirer shall measure the value of the reacquired rights recognized as an intangible asset on the basis of the remaining contractual terms. Okay, so that's all. So if it has already been measured and it is still remainder amount is there, that will be the value. So I need not measure it because it's already been measured. Okay, so very interesting, guys. So now come to this question. Exceptions to the measurement. Reacquired right is an exception. Share-based payment exception. Asset held for sale exception. Exception to exception, which means it is applicable. Contingent consideration. Wow. So contingent consideration will not come under exception because please look at this contingent consideration, which has to be measured. Okay. Now I just take you to this particular paragraph. This will actually happen. Whenever I buy a company, okay, I will not have money. So I will say your company is doing very well, take this money. But after acquisition, the synergy will be there. There will be expansion in my turnover. Because both your turnover, my turnover, there will be synergy benefits will be there. So we expect the turnover to actually hit a particular ceiling, or it may cross that. So therefore, whatever the delta, if alone we will be achieving only this, but together we will achieve some delta turnover. So on that we'll have some delta profits. So we assure you that at the end of first year, when we achieve this, we'll give you an additional consideration. So that, how do you measure it and how you will recognize it? You have the prescription in 39 and 40. So therefore, that will not come under the exception. Okay. Now let me take you to this is your very important paragraph. Okay. See what will happen. I'll just share with you some interesting examples here. See, look at this example. On 1st April 2021, Fruits Limited acquired 15% stakes in Mango Limited. Okay. And there is no concept called subsidiary company under the Indian accounting standard. Maybe if you look at this, okay, so look at this 110. This is 110. 110 is consolidated financial statement. Now here, let me take you to the appendix. Look at this is your appendix. I told you there is no terminology called subsidiary company, but there is a terminology called subsidiary. Only subsidiary is there. And subsidiary, they don't define at all in terms of percentage. Only Companies Act only say above 50%. Entity that is only controlled. The word control only is there in Ind AS. And control doesn't mean only share capital. I repeat the word control doesn't mean only share capital. Share capital is also one way of controlling. But share capital alone is not the way of controlling. Okay. So now 15% stakes have taken. Then on 5th April 2022, Fruits Limited acquired another 20%. So 20 plus 15, 35 ho gaya. On 31st March 2023, Fruits Limited acquired another 65%. So another 15 plus 20, 35, 35 plus 60, 100. Oh, now this is called step acquisition. An acquirer sometimes obtained control of an acquiry in which it held an equity interest immediately before the acquisition date. And Ind AS 103 refers to such a transaction as a business combination achieved in stages. Paisa nahi hai uske paas. Okay, I don't have money to buy in full. So slowly only I will buy in installment. Okay, in systematic investment plan. Okay, so this is like your systematic investment plan. Okay. So it is also referred to as reverse acquisition. No. Reverse merger, I gave another example. Step acquisition, yes. So it is actually 4B. Good. Now, let me take you to, so I think this is another interesting example. Say on 31st December 2021, Entity A holds a 35% non-controlling equity interest in Entity B on the date. Entity A purchases an additional 40% interest in Entity B, which gives it control of Entity B. So this transaction is referred to as business combination achieved in stages, sometimes also referred to as step acquisition. Okay. So step acquisition or business combination achieved in stage. So both are same. Okay. Good. Now let me take you to another interesting question. So I'll take you like this. Now this is an important thing you need to understand. Okay. So what is this? See, under this Ind AS, this is your Ind AS 103. They have a terminology called acquisition date. That is in your Appendix A, acquisition date. Okay, the date on which the acquirer obtains control of the acquiry. And actually, this term control has not been defined at all here. Then where it is defined? 110. So you go to 110, the term control, control of an investee, investor. So an investor controls an investee when an investor is exposed or has rights to variable returns or involvement and has ability to affect those returns to power over the investee. So this one paragraph alone, if I have to explain, I need to explain in 1 hour. So that much of information is there. So I have to give a lot of examples. Okay. So don't alone jump to conclusion that shareholding alone is control. Okay. That is why this term control is not actually defined here. And if you go to the last paragraph, they will say the term control is already defined in other paragraphs. Okay. Check. Now, I want your attention to this term called acquisition date. So the date on which acquirer obtains control. Now, I'll take you to this interesting MCA General Circular 09/2019, which is dated 21st August 2019, which very clearly mentions that the term appointed date is the term used in Companies Act. The term acquisition date is a term used in the Indian Accounting Standard. MCA Circular number 9/2019 is a circular that bridges both this terminology. It says the appointed date under the scheme of amalgamation, scheme of merger, okay, shall also be deemed to be the acquisition date and date of transfer of control for the purpose of conforming to accounting standard, including Ind AS 103 business combination. So therefore, this appointed date is called as acquisition date. Now, look at this question number 28. It says, Ultratech Cement has filed a merger scheme in NCLT. Now, that is scheme. Shall also be deemed to be identified under the scheme. Okay, good. Now, has filed a merger scheme in National Company Law Tribunal for the merger of Binani Cement. Okay. The appointed date is 1st April. Wow. However, the NCLT gave its approval on 30th April 2020. So the approval date is 1 year later, okay, after actually 13 months. And henceforth, from the order date, control also transferred. Okay. Date of approval of financial statement is 30th May. So from which date business combination will be accounted for? Very interesting. Now you have 3 dates. Okay. So which date you will actually take? Is it NCLT gave its approval on 30th April and henceforth from the order date only control also transferred. The control. So you will say no, on 1st April we will actually do the business together. But NCLT have to give its approval. Then only the actual control. Otherwise, control doesn't have a legal standing. Please understand. Okay. Maybe the NCLT gave its approval and approval from 1st April 2019 also possible. They can also do that. I'll give you another interesting example. Please look at the Ultratech Cement annual report. I'll just share with you an annual report, which is in that I'll show you the practical way in which look at this. So I will say India is 103. Look at this. Look at this. I think this will give you the clear-cut answer about the term called appointed date. Because this is an exam question. The scheme of demerger among Century Textiles and the company and the respective shareholders and creditors, that is the scheme, was made effective from October 1, 2019. Okay, effective. So please understand 3 terminologies. Effective date is different from the appointed date or the term what we call it as the acquisition date. Okay. So here it is called effective date, October 1st. The NCLT had approved the scheme by its order dated 3rd July and fixed 20th May 2018 as the appointed date. Wow. Scheme was effective from 1st October and appointed date is 20th May. So order date is 3rd July. This. So effective date, order date, appointed date. Okay. So in the order, the appointed date should be mentioned. So therefore, 20th May 2018. Okay. So therefore, 20th May 2018 is the sacrosanct date. From that date only, the merger will happen. From that date only, the consolidation will happen. So consolidation cannot happen before this date. Consequently, the company had included the financial results. Look at this. Consequently, the company included financial results in its standalone with effect from 20th May 2018, which is deemed to be the acquisition date. That word deemed is taken from where? Deemed is taken from this. Okay. So deemed to be the acquisition date. This word is given in MCA circular. So therefore, the approval should be given by NCLT, and in that approval, the appointed date should be mentioned. And here, henceforth, from the order date, the control stands. Therefore, 30th April is the answer. So C is your answer. So 28C. Okay. Good. Now, let me take you to goodwill. Now, I want to make one observation with respect to goodwill, guys. Okay. Now, what is meant by goodwill? What is meant by bargain purchase? Okay. Now, let me take you to one interesting question here. When you buy a company, when you acquire a company, the net asset, the net fair value. Now, please look at this particular question itself. Now, I'll take you to this. Look at this. The fair value of the identifiable assets and liabilities, 6,000 crores, 9,000 crores, liability 6,000 crores. Net fair value is 3,000 crores. Now, this 3,178.89 crores, the consideration transferred is 5,000 crores. For a 3,000 and odd worth of net fair value, 5,000 and odd worth of crores money is transferred. Naturally, 2,208.82 is money paid in excess. Okay, surplus. This is called goodwill. And this goodwill is paid only because of intangible asset which is not recorded in books of accounts. Okay. You already have intangible assets. Please look at this. Intangible assets, you are paying 1,000 crores. But why you are paying another 2,000 crore extra? Not recorded in books of accounts. You see worth in it, value in it. That is why you pay more than what is there in your business. Okay. So today, TCS, when they did the share buyback, 1 rupee share was bought back for 3,000 rupees. 1 rupee share was bought back for 3,000 rupees. My goodness. Okay. Market value was not even 3,000. Market value was only 70% of 3,000. That means it was only 2,100 or 2,200. Okay. So this goodwill is attributed to the synergies in cement prices and cost. Okay. Now come to this point. Now, how will you treat goodwill under 103? Okay. So goodwill is actually a residuary figure. Remember, goodwill is actually a residuary figure. Now, goodwill, is it an intangible asset? It is a residual figure. It is moment you say intangible asset, then it should be identifiable, then it should be amortized, there should be a useful life for it. All this stuff will be there. Goodwill is a very unique terminology. Okay, goodwill is very unique term. So therefore, please look at this. So you have a separate paragraphs with respect to the goodwill part. So I'll come to this. Look at this paragraph. Measurement period. I'll come to this paragraph. Additional guidance, contingent consideration, consideration transfer. Okay. So bargain purchase here. Please look at this. Okay. So this is the paragraph which speaks about goodwill or bargain purchase. Now, what is goodwill? The example what I showed is an example for goodwill. Now the same reverse happens. This is what for 3,000 rupees net asset, if 2,000 is paid, then 1,000 is called bargain purchase. Now, come to this para. So you have this paragraph here. Now, how will you actually treat this goodwill? Treatment of goodwill and bargain purchase. The treatment of goodwill and bargain purchase is not discussed in 103. It is actually discussed in 110. See, when you consolidate, what will you do with goodwill? Goodwill cannot be amortized. Okay. Goodwill has to be recognized, but it cannot be amortized. So come to this paragraph. Okay. So I'll take you to treatment of goodwill under 103 arising in the case of business combination, charged to P&L in first year, not to be amortized, but annually tested for impairment. Amortized over 5 years, amortized over 10 years. Charged to P&L is also amortized only. But where is it given? Okay. Actually, in standard, it is not given. So what I will do, I'll take you to the Appendix B. In Appendix B, I'll take you to B67, the last paragraph. Okay. This is your B67, 64, B67. Okay. Then B67, I'll take you to D. A reconciliation of the carrying amount of goodwill at the beginning and the end of the reporting period should be shown separately. Here it should be shown. In the annual report, it should be shown. Okay. In the annual report, it should be shown. I'll show you that para also. Now here, I'll take you to the fourth para and fifth para. The impairment losses recognized during the reporting period, this alone will be used for the purpose. So India's 36 requires disclosure information about recoverable amount and impairment of goodwill in addition to the requirement. For example, your net asset. Now, why I'm making this particular point is, you have this net asset, no? You have this net asset 3,000. You bought it for 5,000. Now, at the end of the year, at the end of every year, you find whether it is impaired. 3,000 is impaired. If out of 3,000, 178.89, the realizable value is only 2,000. Then 1,178 is impaired. This 1,178, will you reduce from the asset? No. You will reduce from the goodwill only. 1,001, because already goodwill is there. So that goodwill only you will take it to P&L account. Okay. So only when the impairment happens, goodwill will be charged off to P&L. So that is why this para is important. Impairment laws recognized during the reporting period in accordance with Ind AS 36. What is Ind AS 36 says? Ind AS 36 requires disclosure of information about the recoverable amount and impairment of goodwill. That's all. This is the only thing that has been discussed. So you have to go to 36 and 110. 36 and 110 only will speak about the treatment of goodwill, the amortization of goodwill. Actually, there is no concept called amortization. So please understand this term. So 27B. Okay, good. Which of these are acquisition related costs? My God. Okay. So what I will do, I'll take you to para number 53. I'll take you to para number 53. Look at 53 para. So this is 50. Acquisition related cost. Now, generally, it is not one day. Even Indian marriages doesn't happen one day. So there will be a bride seeing ceremony, then confirmation will happen. Okay. Of course, the tiffin and all will be there, and sweet karam will be there. Then after that, patrika. Then after that, the lagna will happen. So all this, and there will be various functions. So certain marriages, ceremonies and all will be going on for months, 1 month, 2 months, 3 months. So they'll have a lot of functions. Okay. So very similar to that is only an acquisition of business. So there will be a lot of expenditures. Better to have a separate secretarial department, a separate acquisition office, and all the expenditure will be done only through the acquisition office. Now that acquisition expenses, what will you do? Will you accumulate it, keep it in balance sheet, and then amortize it over a period of years? What 53 says? Acquisition related costs or cost incurred to affect the business common. Finder's fees, advisory charges, legal, accounting, valuation, professional charges, consulting, general administration, including the cost of maintaining a separate secretarial department, internal acquisition department, cost of registering the debt equity. All these are acquisition related costs. Wow. Now answer this question. Advisory fees, yes. Legal and accounting, yes. Valuation other, yes. All of the above. So 26D. Which paragraph? 53. Now, what will you do with this? See, this is only valuation question. So not an accounting question. But majority of you are chartered accountants, cost accountants. So you must also know, you also complete that circle so that you will know the relationship of this particular cost with respect to the business combo. Okay. So you will not capitalize it. You will actually charge up to revenue. So the acquirer shall account for the acquisition related cost as expenses in the period it is incurred. That's all, matter over. Kata. Okay. The only exception is the cost of debt and equity securities will be actually treated as per Ind AS 32-109, because there they say you need to actually find the cost. When you find the cost, you need to include these costs and then you need to find the effective interest rate. So that effective interest rate, these costs will be used to find EIR. So the effective interest method. So that is why this portion alone is different. Okay. So very interesting. So now come to now the acquirer shall account for the potential tax effects of temporary differences and carry forward of an acquiring that exists at the acquisition date or arise as a result of acquisition in accordance with. Now, I just want to share with you this question number 25. I'll take you to para number 25. Okay, so look at para 25. This paragraph is with respect to income taxes. Okay, now the acquirer, the buyer, shall account for the potential tax effects or temporary differences Now, what is the temporary difference? Temporary difference is your depreciation. There is no permanent effect. It is only temporary difference. So the tax effects of temporary difference and carry forward of the acquiring. What is carry forward? There will be losses. So the losses, and as per section 72 of the Income Tax Act, when you acquire a company, okay, so the acquirer is also eligible to carry forward the acquiree's carry forward loss. So when carry forward loss you are carrying forward, you have a tax benefit on it. Okay, so you have a deferred tax asset on it. Okay, so similar temporary difference, you may have a DTL or a DTA. Okay, so now what do you do with that? So how will you do the accounting part with respect to that? How will you measure it first of all? Okay, the acquirer, the potential tax effects. Okay, as a result, in accordance with Ind AS 12. Ind AS 12 is income taxes. Okay, so you need to measure the differences and then you have to recognize it. So first of all, you have to identify the effect. So this is as per para 25. So answer is B, Ind AS 12. So you need to know all this. So you know 113 is fair value, 103 is actual business combo, 109 is your financial instruments, 12 is income taxes. Okay, so as per 12 only you have to do it. So how this one standard is connected with so many standards? Please understand that. Acquisition related cost, one more question. Acquisition related costs are costs the acquirer incurs to affect the business combo. Those costs include, except, just no visa, the cost of registering issue debts, statutory dues, finder fees, advisory, legal, accounting, valuation, other professional, general administrative. Now, all things are there. Cost of registering issue debt and security is also there, except statutory dues. Statutory dues is an acquisition related cost. It is not. Just now I showed you that. Your acquisition related cost is in para 53. Look at para 53. This is your para number 53. So here, finder fee, advisory, accounting, valuation, including cost of internal acquisition, cost of registering, issuing, debt security. All are there. But statutory dues are not. Statutory dues cannot be. It all depends on, for example, your statutory dues are with respect to payment of taxes, payment of EPF. Okay, so there are EPF related dues of the acquiring. Can you treat that as an acquisition related cost? No, those are all liability. Okay, you have to find the fair value of liability and you'll subtract that and only you will pay. So B is not an acquisition related cost. So silently they'll include all this. It will look as though that is also, but unless and otherwise you read the standard, appreciate the message, meaning in it. So no rata marne se kuch bhi nahi hoga. Okay, please understand this. So nothing will happen. So please understand and then do it. So reverse acquisition. See, this is very, very interesting. Okay. Now, this will happen actually, even in marriage also. So before marriage, the male and female, they get married. Okay, the boy and the girl. Okay, the boy always will feel, okay, I am the legal acquirer. Okay, I'm going to actually marry a girl. So whatever I say, she will do. So we are not going to get one life partner. So everything will happen as per my dreams. Okay, but very poor fellow, he doesn't understand that post marriage, okay, he may be the legal acquirer, but the accounting acquirer. So what happens after marriage is he will feel that he only is the legal acquirer, but the accounting acquirer is different. Okay, I'll just share with you some interesting examples. Okay, see, please look at this. I think one example I'll show you. You will be quite surprised. Maybe this is one example I'll show you. Please look at this. Where A and B, I'll just view. Sorry. So what I will do, this is the company called A Limited. Okay. This is a company called B. Okay. This is your acquirer. This is your acquiree. So, acquirer already is having, so let us say 800 shares. Okay. Acquiree is having, let us say, so we'll say he's having 300 shares. Good. Now, that is the ratio. 1:2, okay, 4. 1:4, I must say. Ratio is 1 for 4. I'll say 4 for 1. I'll call it as. So this is the ratio at which this is the swap ratio. Okay, this is swap ratio. So that means for 300 shares, how many shares are issued? So 300 into 4, 1,200 shares are issued. So now what happens? What is the total? Sum is 2,000. Now out of 2,000, the 300 shareholders are having 1,200 shares. So you are holding 100% of this, but actually what is happening? Look here, 1,200 divided by 2,000. So 60% B is already having. So then he becomes legal acquirer. This is legal acquiring. Legally is acquiring, but you become the accounting acquirer. You become the accounting acquirer. So that is what this question says. Look at this. In reverse acquisition, this is what reverse acquisition. The private entity will arrange for a public entity. Okay. So what I will do, I'll take you to a paragraph called B19. Okay. So to B23. So up to B23, up to this paragraph. Okay, good. So now look at this particular paragraph, B19. Reverse acquisition happens when the entity that issues securities is identified the acquiree for accounting purpose on the basis of guidance in B13 to B18. The entity whose equity interests are acquired must be the acquirer for accounting purpose for the transaction to be considered a reverse acquisition. So you want the objective is reverse acquisition. This is the objective. So this is the objective. So that is why I said business. No. I am getting 100% holding 100%. No. The objective of doing this business is, okay, why I am giving 4 for 1? I could have given 2 for 1. No. If I give 2 for 1, then only 600. Then this reverse acquisition will not work out. Why I am giving more shares? More shares is given because reverse acquisition should happen. Then B will not be merged with A will be merged with B. That is the purpose. And 103 allows you that. 103 allows you that and have an agreement that even though legal acquirer is this, you are acquiring 100% stake, 100% stake, 100% stake. No. By accounting purpose, you become reverse acquisition. Therefore, A only will be merged with B, not B will be merged with A. This is how the scheme should be designed. This is how the agreement will be drafted. Okay. Okay. So this is what it is. Now come to this question. So in reverse acquisition, the private entity will arrange for a public entity to acquire its equity interest. So this is your private entity. This is your private. Okay. And this is your public company. So your public company, look at this. Private company will arrange for a public company to acquire its equity interest in exchange for the equity interest of the public entity. Here the public entity is the, now look at this question. Okay. The private entity will arrange for a public entity to acquire its. So in this example, the public entity is the legal acquirer. Okay. Because it issued equity interest and the private entity is the legal acquirer. So here the public entity is the legal acquirer. So I gave the example. Public entity is the legal acquirer and the private entity is the legal acquiree. So understand this example. Then only you can actually answer this properly. Otherwise, Bus Govinda. Okay. So 23A. Good. Now, I want to make one more point here. Now, look at this example. Public company is the legal acquirer. Public company is also the accounting acquiree. Wow. Oh my God. So, and the private company is also the accounting acquirer. So this question has two answers. What is the first answer? A. What is the second answer? C. Accounting acquiree. And B is the accounting acquirer. So C is also an answer. So 23 has two answers. Both are correct. So that is why I said caution. So please be careful. Okay. Good. So now, guys, I will just wait. So this question has two answers. What is the first answer? A. So now let me invite some people to share your thoughts. So maybe you can raise your hand, wish to hear from any of you who wish to share your thoughts. Can I request Gopal Ketan? Gopal Ketan, you can unmute your audio and video and share your thoughts, please. And maybe we'll request Mahendra Tiwari. Mahendra Tiwari, I'll request you to kindly unmute your audio and video. And Akila is there. So may I request Akila to unmute your audio and video. Audio alone also you can do. Hanita Raj is there. May I request Hanita Raj to unmute. Vishal Singh. May I request Vishal Singh to kindly unmute. Venkata Krishnan is there. Mr. Venkata Krishnan, good morning. Yes, Mr. Venkata Krishnan. Good morning. You can now talk.
Good morning.
Yeah, please go ahead.
Wonderful to see you again back. And it was a very crisp but short and very useful for the exam. And I look forward to furthermore on NDAs, fixed income securities, your usual stuff. Thank you very much.
Thank you, Mr. Venkata Krishna. You can just briefly introduce yourself also for the benefit of the members.
Well, I'm a fellow member of the Institute of Chartered Accountants of India. I was in the industry for quite a long time with Tata Motors, and I had a great stint outside India in the Middle East. I am back here and I'm into business consulting. And because of the business compulsions, I would like to become a registered manager. Thank you.
Very good, very good. Now let us hear from Mr. Vishal Singh. I have just enabled you. You can talk now. Good morning,
sir. Good morning, sir. I am Vishal Singh, practicing chartered accountant from Varanasi.
Varanasi, yeah.
Yes. I have listened a lot of sessions of you, and I am interested to clear the valuation. And it is very interesting, and I have a lot of exposure I am getting to in this learning of the valuation course. Thank you, sir. And please guide us regularly.
Thank you. Thank you. Let us now hear from Mr. Tiwari. Tiwari ji, very good morning.
Hello, sir. My voice is coming, sir?
Absolutely clear and loud.
Okay, sir. Thank you, sir, for taking this lecture, sir.
My pleasure. My pleasure.
I have cleared valuation classes because of your lecture only, sir. After attending your classes, I cleared my valuation exam. And I have cleared my valuation, my insolvency professional and all 4 exam also because of your lecture only, sir.
Very good, very good. So our best wishes to the entire team members. So let us now hear from Aditya. Good morning, Aditya. Rajat Kumar Mehra. Rajat Kumar Mehra. Yes, good morning, Mr. Rajat.
I see.
Oh, very good morning. Please go ahead. You are
Sir, I have been watching your videos and I have not seen personally. so much knowledgeable about India's. Maybe others might have seen you have command over all the Indias, and give us little bit out of that to relevant to our syllabus. Maybe you take more sessions for us.
Sure. Thank you very much, Rajat Bhai. Our best wishes to you. So, friends, thank you for the wonderful session and being with us in the morning. My best wishes to each and every one of you, and prepare well. And any feedbacks, kindly get in touch with me either by phone or by email. I'll just share my email ID. It is gkr@icai.org. I've just typed in the chat box. Or this is my mobile number. So you can share your feedback either by email or to my mobile. Thank you very much. My best wishes.